Hello everyone, this video is on cash flow statements. This video is relevant for all the students whether they are in class 12, BCom or pursuing CA. So what is the cash flow statement? A cash flow statement shows the inflow and outflow of cash through various business activities. Now these activities are divided into three parts: operating activities, investing activities and financing activities. Operating activities include all the receipts and payments relating to revenue generating activities or the core business activities. For example, purchase sale of goods, salary to employees, income tax payment, etc. Investing activities include all the receipts and payments relating to purchase and sale of fixed assets and investments. And in the end, financing activities include all receipts and payments relating to debt and interest on debt, or issue of equity shares, or proceeds from issue of preference shares, or dividend paid on equity shares or preference shares, and any other expenses or payment relating to above. You can take a screenshot of these points or now we will understand cash flow statement with the help of some examples. Let me tell you the format in which these examples are made is only a rough format for your understanding purpose. Now let us assume that you are the owner of a shop and in the morning when you came there was an opening balance of cash of $500 and in the evening there was a closing balance of $1,500. So you conclude that there was a net cash inflow of $1,000. But from this information, can you tell what was the total cash inflow and what was the total cash outflow uh, from your business? The answer is no. And now, what cash flow statement does for you is this tells you what was the total cash inflow and outflow from various business activities such as operating activities, investing activities, and financing activities. In this example, you can see that the cash flow from operating activities was $3,000 and the cash flow from investing activities was minus $2,000 and the cash flow from financing activities was zero. So you can now find out the total cash inflow and outflow using this statement. Now reconsidering the same example, cash flow statement can also be used to analyze the performance of a business. Let us assume that these are the annual figures of a company. Now, the company is earning profit from its operating activities. The operating activities are the core business activities such as purchase, sale of goods and services, etc., etc. And using the this money earned from operating activities to invest in fixed assets and investments. This means that the profit which the company has earned from its operating activities is being utilized in investing in fixed assets and investments, which is a good thing. Now let us consider another example. Now in this example we can see that the cash flow from operating activity is negative and the cash flow from investing activity is 2000 and the cash flow from financing activities is 12 minus 1200. Now what can we conclude from this? We can conclude that the company is selling its fixed assets to cover its losses of operating activities. The company is selling its fixed assets to cover its losses of operating activities and to repay its loans and other obligations and financing activities. So from this we can conclude that the financial performance of the company is not very good, and this is the way we can use the cash flow statement to analyze the financial performance of a company. These are three statements showing various contents of balance sheet, trading account, and profit and loss account. The balance sheet and trading and profit and loss account represent the activities of the business. These are the only activities which we do in business. These activities are a combination of three different type of activities. The trading account and the P&L account represent the activities from operations. These are the activities related to the operation. These are the activities which fall under normal course of business. As we all know, there is a net profit given at the bottom of P&L account. But does this net profit represent the cash generated from operating the business? No, it does not represent the cash generated from operations. The net profit given below might include expenses relating to non-cash items Incomes credited to P&L account which are non-cash items. Incomes and expenses relating to some other activities may also be included in this profit account. All the transactions related to purchase and sale of fixed assets and investment are a part of investing activities. When we purchase fixed assets or investment, there is a outflow of cash. And when we sell these fixed assets and investment, there is a inflow of cash. All the expenses incurred in relation to these fixed assets and investments are a part of investing activities. And all the incomes generated from holding these fixed assets or investments such as interest, dividend, rent are also a part of investing activities. Note that purchase or sale of current assets is not a part of investing activities. Now the liability side of balance sheet, excluding current liabilities, is a part of financing activities. In the financing activities, there will be inflow of cash when we issue shares, debentures, or loan, and there will be outflow of cash when we buy back or redeem shares, or there is repayment of loan or interest, or there is a payment of dividend on shares. Now I will tell you why current liabilities and current assets are not a part of financing and investing activities. Now, as I have previously told you that activities in trading account and P&L account are a part of operating activities. Now, if we compare the debtors which are in balance sheet are originated from sales, which is a part of trading account, and the bills receivable are originated from debtors only. And the stock which we are seeing in balance sheet is this closing stock only. And also the creditors which are in balance sheet are a part of purchases, and the bills payable are to these creditors only. And also these outstanding expenses are originated from the expenses given in profit and loss account only. That's why we can conclude that the current assets and current liabilities are the part of operating activities. Now I will tell you about four rules of cash flow statement. These are: when there is an increase in current assets, there is an outflow of cash. When there is a decrease in current assets, there is an inflow of cash. When there is an increase in current liabilities, there is an inflow of cash. And when there is a decrease in current liabilities, there is an outflow of cash. Now let me explain these rules to you in detail. Now here are some statements showing opening and closing figures of current assets and current liabilities of two different years. Now here I have considered two current assets and two current liabilities. The two current assets are these. The first one is debtors and the another one is stock. These two are the current assets, and below that there are two current liabilities given. One of them is creditors and another is outstanding expenses. These two are current liabilities. Now let us go back to the rule and what the rule says about current assets. The rule says that when there is an increase in current assets, there is the outflow of cash, and when there is decrease in current assets, there is an inflow of cash. Now let's see. Now debtors and bills receivable are the people from you who have not received money. Okay. Now in year one, you can see that in the starting of the year, we have not received $1 lakh from the people, and in the end of the year, the amount of money you have not received from people uh, increased by 1 lakh to $2 lakh. This means that we have not received extra $1 lakh, and therefore there is a cash outflow of $1 lakh. Okay, outflow. And in year two, you can see that the opening balance of debtors and bills was 2 lakh. This means that you have not received $2 lakh from the people, and this balance came down to 1,50,000. And this means that the amount of money you have not received from people has reduced by 50,000, and therefore there is a cash inflow of 50,000. Okay. Now the case of opening stocks, you can see that when in the beginning of the year there was a opening stock of one lakh dollars, and in the end of year one there was a closing stock of $2 lakh. Therefore, it means that the stock has increased by $1 lakh, and therefore it means that you have paid extra $1 lakh, and therefore there is a and when you have paid extra $1 lakh, therefore there is a cash outflow. And in year two, you can see that the balance of opening stock is $2 lakh, and the balance of closing stock is $1,50,000. This means that the amount of stock is reduced by $50,000, and therefore you have paid $50,000 less this year, and therefore there is a cash inflow. Okay. Now, as you can see in both the current assets, whenever there is an increase in current assets, there is a cash outflow, and whenever there is a decrease in current assets, there is a cash inflow. Now, let's move on to current liabilities. Now, creditors are the people to whom you have to pay money. Okay. Now, in year one, in the beginning of the year one, the opening balance of creditors was $1 lakh, which increased to $2 lakh by the end of the year. This means that in the beginning of the year, you have not paid $1 lakh to the people, and in the end of the year you have not paid $2 lakh to the people. This means that you have not paid extra $1 lakh to the people, and therefore there is a cash inflow of $1 lakh. Okay, and in year two, in the beginning of the year, you have not paid $2 lakh to the people, and by the end of the year, you have not paid $1,50,000. This means that you have paid extra $50,000, and therefore there is a cash outflow. Same thing applies to these outstanding expenses. In the beginning of the year, you have not paid $1 lakh in the beginning of year one. Okay, and in the beginning of year two, you have not paid $2 lakh. This means that you have not paid extra $1 lakh in year one, and therefore there is a cash inflow in year one. And in year two, you can see that you in the beginning of the year you have not paid $2 lakh, and in the end of the year not paid $1,50,000. Therefore, it means that you have paid extra $50,000 this year in year two, and therefore there is a cash outflow in year two of $50,000. Okay. Now let us start with cash flow from investing activities. Now, investing activities, when you will save fixed assets and investment, there will be a inflow of cash. And whenever you purchase fixed assets or investment, there will be a outflow of cash. Okay. And cash flow from financing activities, whenever you issue shares, debentures, loan, there will be a flow of cash. Okay. And whenever you buy back, redeem, or repay your loan, there will be a outflow of cash. Okay. Now, this I have explained you the broader concept. This interest on income from investment and interest dividend loan I will explain you later, and we will do our operating activities. Okay. Now to find out cash flow from operating activities, there are two methods. One is the direct method, and another one is the indirect method. We will start off with the indirect method, so that you can gain some understanding about other activities. Okay. Now, in indirect method, we start with net profit. So here you can see net profit is given. Now, in cash flow from operating activities, we are only concerned about the cash inflow and outflow from operating activities, and not we are not interested in the profit generated from operating activities. Now, this net profit given below, this net profit does not represent the cash generated from operating activities. This net profit involves has many adjustments asked to be made to this net profit. This net profit requires many adjustments to be made. Those adjustments include removal of non-cash items, removal of items which are not a part of operating activities, and removal of incomes and expenses which are also not a part of operating activities. Okay. This net profit require many adjustments. We have to remove all the non-cash items, all the items which are not a part of operating activities. They may be part of financing or investing activities. So therefore, we have to remove all these items to find out the cash generated from operations. Okay. This represents the net profit, this net profit does not represent the cash generated from operations. So let's find out how can we find the cash generated from operations. Okay. So first we will write the net profit. Okay. And then we will add provision for tax. So why we will add provision for tax is because provision for tax does not involve any transfer of cash. It is just a provision made and it is a book entry. It does not involve any payment of tax. For making provision for tax does not involve any payment of tax. Therefore, it is just a book entry and a non-cash item because there is no transaction of cash involved in making provision tax. And therefore, we will add provision for tax back to the net profit. Okay. Now we would have paid some tax in the year. This is a provision made. So there would have been a certain amount of tax which we would have paid in the year, and therefore we will deduct that amount in the end of the statement. Okay. Now let's move on to another item which is transfer to reserve. Now transfer of to reserve also does not involve any transfer of cash. It is just a book entry and no cash transaction, no cash inflow and outflow is involved when transferred to reserve. So therefore, it is a non-cash item and we will add it back to net profit. Okay. Now another one is proposed dividend. The proposed dividend is just a dividend which we are going to pay in the future. It is not a dividend which we have actually paid. Okay. And therefore, it is a non-cash item and it is just a book entry to show the amount which are we are going to pay in future. Okay. And therefore, it is going to be added back to the net profit. Now, next one, now salary, electricity, and tax are a part of this. Now, only salary and electricity are a part of this operating activities only, and therefore no adjustment is required to be made to these. We are assuming that salary and electricity expenses are paid in cash. Now, next is interest on loan. Okay. Now, interest on loan is a part of financing activity, and therefore we have to remove it from operating activities. So we add back the interest on loan deducted in operating activities and deduct it in financing activities because it is a interest on loan is a part of financing activities because it is the interest paid on loan which we raised to finance our business.
Now moving further, our next item is this loss on sale of asset. Now, loss of sale of asset not a cash item. Let me explain you why. Now, whenever we sell the asset, we make the entry bank account debit, loss on sale of asset account debit if there is any loss, to asset account, to profit on sale of asset account if there is any profit. Now in cash flow statement, we are only concerned with this bank part because this is the only part which represent inflow and inflow of cash. Okay. And this loss on sale of asset does not represent any outflow of cash, and this profit of sale of asset does not represent any inflow of cash. These are just book entries to show the amount of profit and loss which we made, and and they do not represent the inflow and outflow of cash. Therefore, they are non-cash items and we have to remove them from operating activities. And this bank account which is debited when we sell asset will be a part of investing activities. As you can see, the sale of fixed asset, there is an inflow of cash, and
So we will add back the loss on sale of asset to the net profit. Here I have written it twice by mistake. Okay. And we would deduct the income from investments, which is interest, dividend, and because this income is a part of income which we have received is a part of investing activity, and therefore it will be added in investing activities. Here you can see I have added this income from investment which was in P&L to the investing activities. Okay, and we are assuming that this income is received in cash. Now the last two items are goodwill and depreciation. Okay, now when we these both are non-cash items, as when it charges depreciation there is no outflow of cash, and same is the case with goodwill, and therefore they both will be added back to the net profit because they are reducing the net profit. Okay. Now we reach to the cash flow from operations. Reach to this part, the cash flow from operations before adjustment of current assets, current liabilities, and tax. Now, as I previously told you sometime before that whenever there is a decrease in current assets and increase in current liabilities, there is an inflow of cash. And whenever there is an increase in current assets and decrease in current liabilities, there is a outflow of cash. If you have not understood this concept, you can back in the same video and watch that concept again. So here we no. So after adjusting this, what we get is cash flow from operating activities before tax. Now we reduce the amount of tax which we actually paid. Okay, and then what we get is cash flow from operations. Now we can find out net cash flow by adding cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. So the total net cash flow during the period will be A plus B plus C. Okay. To this we will add opening cash and cash equivalents. Now, opening cash, so you understand the normal cash which is in balance sheet. Now cash equivalents are those items which those things which are easily convertible into cash. For example, treasury bills, commercial paper, etc. Okay, these are ready. These things can be converted into cash in a very less time. That's why they are termed as cash and cash equivalents. So to the net cash flow during the period, we will add cash and cash equivalents, and in the end we will get closing cash and cash equivalents. So here is your complete cash flow statement. I I have first completed the indirect method to calculate cash flow from operating activities. Now next I will explain you the direct method to calculate cash flow from operating activities. Now the method which I previously explained was the indirect method, and now I am going to explain you the direct method. The direct method is rather a very simple method, and it is very easy to understand. Now, how do we find out cash flow from operating activities in direct method? Let us know. Now first we write here the cash sales. Cash sales are sales which is made in cash rather than credit. You know, the sales are of two types, cash and credit, and we have to write here only cash sales. Okay, cash sales, and we have to write cash sales only. Okay. Next thing we have to do is less all cash paid for all operating expenses. Cash paid for all operating expenses will include cash paid for purchases, cash for salaries, cash paid for electricity, cash paid for direct expenses, etc. Cash paid for all operating expenses. Now, after we deduct cash paid for all operating expenses, we get cash flow from operations before adjustment of current assets and current liabilities. Now, from here it is the same as it was in indirect method. We add the decrease in current assets and increase in current liabilities and less decrease in current assets and decrease in current liabilities to get cash flow from operations before tax. And we reduce tax paid in cash to get the cash flow from operating activities.